Money Mindset Mastery Show. Today, I'm excited to introduce you to Kyle from Newlook Dental. I'll also introduce Jim and Ryan, who are usually with us. Jim's usually our host. Today, I get to sit in his chair somewhat. But Kyle, I want to introduce Kyle. The reason we brought him on is he works with Newlook, and they have a dental fund that has some really interesting aspects that bring diversity to portfolios. So today we want to talk about how an everyday trip to the dentist connects to private equity, to passive income, and to the growth of an entire healthcare platform. Um, so Kyle, welcome.
Yeah, thank you very much. I really appreciate you guys having me. I'm excited for the conversation today.
Yeah, well, just to kind of give a bit of background on New Look has 35 clinics. I was actually just corrected because I had 33 in my notes, but they're growing so quickly, it's hard to keep track of. 35 clinics, over 83,000 patients, 175 dental professionals, and 185 operatories. Again, that's May 2025. Um, so, how has that process been to get to that point, Kyle? And how long have you been with New Look? Give us a little bit of background about who you are and your involvement there.
Yeah, absolutely. So I joined New Look about 3.5 years ago. I came from a finance background. I did my university degree in finance and economics. I was in the industry for a couple of years, learned about private markets actually at the old firm that I was at. Learned about New Look Capital, and I thought, kind of what you were talking about, right? The different aspects that New Look really has in the funds that we sell here. And I found it very interesting. I come from a background of, my dad, he's owned, a family business his entire life. It's a third generation family business. And it really resonated with me and kind of what New Look Capital does. So that's how I got into New Look. But yeah, very, very excited to be here. And I think there's a lot of opportunity in the market that New Look plays in, right? It's a very niche space. We're really specialists at the end of the day. And I think that's really what a lot of people are looking for, kind of that specialty that they can incorporate into their portfolios, not necessarily the general stuff that they see all over the place. So we're providing that kind of unique spin on private equity markets.
Hey Kyle, I
I,
know a lot
I
of people probably haven't heard of New Look. Maybe provide a
Yep.
bit of background on New Look Capital, who they are, when they started, and what they do.
Yeah, absolutely. So New Look Capital started, officially back in 2016, but the partners at New Look, they've always been owners, operators of businesses since they've been younger themselves, actually. So 2013 was really when we started kind of the thesis of New Look, and then it grew into the actual funds that you see today, starting in 2016. So we're actually in our 10-year anniversary, I guess you could call it. And our specialty really is, again, being specialists in a certain niche. So for us, we do recession resilient type portfolios, and we buy regulated, code mandated type businesses on the industrial side. And then we do very specialized healthcare, which obviously we're going to talk about today on the dental side. So those are kind of the two focuses, the two niches that New Look Capital's in. And that's really kind of the ballpark that we play in.
I, I want to just take a quick minute to highlight the Industrial and Infrastructure Fund future coming up, so stay tuned. That one will be coming. It's as interesting as the dental fund. So to kind of continue on that, my next question was going to be, can you tell us what New Look does in one or two sentences? And I do think you did it
Mhm.
there in three. What's something about the dental business that would surprise a typical patient sitting in the chair?
Yeah, I think, something that might surprise people, it might not though. There's a lot of dentists that really, they don't want to be business owners. And I think, maybe people don't even really realize when they're sitting in the dental chair that these dentists are, in fact, a lot of them are the owners of the clinic. And I think that's, part of the reason we went into the dental space, and what we really built the model around was, hey, these dentists went to dental school. They want to be dentists. They don't want to be business owners and operators. And that's really where we come in, right? Like, we've built a great head office team that can kind of take over the management of the clinic. So I think, I know for me, when I was younger, I never really thought about the dentist actually being the one owning and running the business itself. And I think that's really where our models really come from.
Yeah. To kind of step next into the next step in the process, I want you to tell us about what a dental roll-up is. A lot of people hear that term, especially in private equity. Some people understand it, some don't. So let's kind of stop and explain your dental roll-up, explain what Newlook is trying to do with this dental roll-up, and kind of your long-term plan with that.
For sure. Yeah. So from our perspective, again, like generally speaking, a roll-up strategy is you're taking a fragmented market, you're buying up these businesses, or for us, dental clinics, and you're amalgamating them into one platform. You're buying at multiples of EBITDA at the single clinic level. But when you have an integrated platform of, call it again, 35, 50, 75 clinics or businesses, you can sell that entire roll-up strategy at a much higher multiple because you've done the work of amalgamating them, kind of integrating these platforms, creating synergies, efficiencies, et cetera, and scaling the businesses. So that's a roll-up strategy. You see it across multiple verticals, multiple sectors, Canada, US, all over the world, really. But for us, the essence of it was really the opportunity that we saw in the market. We lagged a lot behind kind of the other developed nations, and we saw that this market was extremely fragmented. It's healthcare. It's very interesting. The margins are great. It's recession resilient. It fits in that model for Newlook Capital. And that's why we really kind of jumped on the idea and on the opportunity. And now we are, call it the fourth, fifth largest DSO dental service organization in all of Canada.
Yeah, you make some good points there. And I do have my follow-up question as a result. There's really, when we're looking at opportunities to put in front of our clients, there's always the market, there's always the business model. But I think the key thing that always stands out as one of the most important, or if not the most important, is people. And so you try to think of, you say business owners, dentists don't like being business owners necessarily. Talk to us about how Newlook's expertise in the private equity side, and then how you bridge that into dental work. Because I know the principals of Newlook, they're not dentists, or they, at least the ones that I had initially met, weren't. So how did you guys solve that problem, and how do you bridge the private equity experience with the dental experience to be able to do this well?
Yeah, so it's a great question, and speaking with Abbas, our CIO, the other day, actually, he's very adamant about us as Newlook kind of moving away from this whole, we're a private equity firm, we're a private equity firm. I mean, definitionally, we absolutely are, but at the end of the day, we're business builders, and I think that's really what we're trying to project out to the market. Is we take these great opportunities, these specialized sectors, and we build these businesses that, these operators don't know how to take it to the next level. And that's where we come in, and that's where our expertise comes in. And that's from our entire, partner group, right? So we've got, Abbas has a long, history of kind of taking businesses to the next level, working with family offices, being on the investment side over the past, call it 30-ish years. We've got Elroy, obviously he's a serial entrepreneur, you could call it, a serial business builder, whether it's on the real estate side, whether it's on, the industrial side. So again, going from that, it's all the same type of principles. When you're looking at taking a business down to its roots and then really building it up from there, it's no different dental versus industrial versus real estate. It's all the same type of concepts. And specifically how we got into dental was we partnered with Dr. Sam. First of all, dental fit the Newlook model very well, right? Recession resilient, recurring cash flow. We love those types of things, very specialized within the healthcare space. Once those boxes were ticked, we found a partner, Dr. Sam. Again, he is the specialist on the dental side. 15 years as a dental surgeon, 10 years in mergers and acquisitions on the dental side. We bought our first 6 practices from Dr. Sam, and he has built our entire team into experts. So we've been doing this now for, call it 8-9 years, just on the dental side specifically. But it's really the same principles from industrial to dental to whatever type of business we're doing. We follow the same kind of process.
And Kyle, could I ask a question? Because I've heard recession resistant a couple of times so far. Maybe explain why dental practices are recession resistant.
For sure. Just as a caveat, Jen, I'm going to use the word resilient, just to make
Resilient.
sure
Okay.
that my
Sorry,
compliance.
I used the wrong word. I apologize. Yeah.
That's okay. That's okay.
Yeah.
That's okay. But yeah, I think look, a lot of it comes from the highly insurance-based nature of the business, right? There's a lot, like if you're employed in Canada, you have most likely private insurance that covers, getting those hygiene, those appointments done on a regular basis. The hygiene side is very recurring. So if you look historically and you look at recessions that have happened back in 2008, 2009, you can actually see that, people take a step back on doing the cosmetic side for your teeth and things like that. But the hygiene really doesn't falter. It kind of maintains. So just looking historically, it's been very recession resilient. The insurance-based nature of the business creates recession resilience. Canadians have a very high dental IQ. We're one of those nations where we really care about our oral health. We're a very educated population, and I think that's, really plays into that. So there's a number of factors that go into it, but that's, I would say some of the big ticket items. We've also got the CDCP, which is the Canadian Dental Care Plan. So for those who aren't on the private insurance side, now we have a whole group of uninsured Canadians that are able to access dental care. So, that's another reason it's kind of recession resilient, kind of another padding for the dental sector as a whole.
Yeah, actually, that leads Jim. You're kind of stealing some of my thunder. The CDCP is coming up on the next one. No. That was a good question and timely. Before we step into that realm, though, I do have one more question. Why is the dental market so fragmented in Canada compared to other places? And like why is that? Why does that exist? Why is that arbitrage or that opportunity there?
Yeah, it's a good question, and I would be, more or less speculating as to the fragmentation and the reason for it. But we lag in pretty much all markets behind the U.S., right? A lot of capital flows through the U.S., and they're kind of the first mover in a lot of these roll-up type strategies or anything in the investment world. So because of that, Canada tends to have a bit tighter regulations. So the dental colleges across Canada obviously are the ones that kind of control the fee guide and everything like that. So higher regulation in Canada versus the US and maybe some of the other developed markets. A lot more capital flowing through, a little bit more entrepreneurial, the US is. Like if you're, from our perspective at least, we see so much more deal flow, obviously on the industrial side, through the US than Canada. And I think that's kind of true, whatever market you're kind of looking at here in Canada. And I think that's really contributed to the fact that the consolidation is happening later. But we really do lag kind of those other developed nations, and we're starting to pick up steam now.
Yeah, if I remember correctly, when I first met Newlook, like 8-9 years ago, the stat in Canada was about 3% consolidation, and now I think you guys show that it's around 9%. What is it in US, UK, Australia, where these have been happening for longer than here?
Yeah, so we're between kind of 25 to 40% in consolidation between US, the UK, and Australia. So as you can see, we need to kind of just double, triple the size or the consolidation just to catch up to these other developed nations.
Yeah, that's again, it is interesting to see how far behind. We kind of think developed nations are all generally close to the same, but when you start getting into nuance, you can see there's significant differences there.
For sure.
So kind of moving on now towards the why dental, I kind of want to find out more about Newlook's investment thesis around this. And I want to highlight that like dental industry revenues are around just shy of 20 billion, growing 2.6% annually from 2012 to 2022. 16,000 clinics in Canada, and again, only 9% owned by these roll-up or these consolidation style things. When you step back and look at the universal healthcare, like pharmacies, optometry, vets, why does dental stand out above those other ones?
Yeah, I think a big part of it is the reason we just talked about, right? The opportunity and the lack of consolidation in the market. I think that's number one. Some other big factors is a business, right? If you're trying to create a fund around a business, you need to know, is that business scalable? Is there an exit opportunity? And for us, dental really seemed to fit that mold. We looked at every other vertical possible, and there really wasn't that same scalability. And the ones where there was that scalability, I'll give you an example, vet clinics. the multiples that you're paying at an individual level are far too high to kind of make a go of it at a fund level. So when we were looking at vet clinics, you're looking at definitely double digit kind of teen type multiples. Whereas for us, we're buying dental clinics between 5 to 7 times EBITDA. So when you're looking at actually building up a fund and creating value for your investors, you need to find something where you can get that multiple expansion and you're not overpaying at the individual clinic level. So I think those are kind of two big reasons as to why dental versus some of these other healthcare verticals that we looked at.
Interesting, yeah. And when you consider too the CDCP, the dental plan from the federal government, you don't have that for your pets. And as much as people will still pay for veterinary service, it does seem like there's a lot more, whether it's a health and dental plan at work or some other insurance plan. It's a lot easier to spend on dental than it is to spend on those other platforms, at least from what I've seen. So how big of a deal is the CDCP to what you guys do? Did you see a change in revenues?
Yeah, it's a great question. So kind of throughout, as the government was rolling this out, we weren't really sure what the impact was going to be. We kind of figured it would be minimal, either negative or positive. But for us, it's adding a lot of traffic that, again, otherwise wouldn't be there, as you can see, just kind of based on the figures that you were talking about earlier. But we don't really see it as, we see it as a tailwind for sure. But I don't see it affecting the fund as a whole a lot, to be honest, right? I think what it really allows us to do is be more comfortable as we're kind of approaching these volatile times, these recessionary type environments. You have this backstop now with the CDCP. If unemployment starts to skyrocket and you have people who don't necessarily have that private insurance, they can hop on, the CDCP plan. There's now this new avenue for people to continue to get dental care. And I think that's just one more layer, for us to not have to worry about, declining revenues or declining EBIT or anything like that. So I think it's absolutely a positive for us. I don't see this pushing us, far above revenue and EBITDA targets that we've already seen. I think we're going to continue status quo, and it just adds that layer of protection for us.
Interesting. I know federal plans can sometimes throw, what's the word I'm looking for? It can complicate things, and sometimes they can be a benefit. So it's interesting to hear how you see it affecting it. So this is a bit of a question that leads us into our next topic, but it's still relevant with how this investment is being managed by you guys. How do you deal with succession of dentists? So you buy a practice, maybe that dentist wants to keep working, maybe they want to retire. What are the options you generally see, and how does Newlook handle that?
Yeah, so for us, what we look for is dentists wanting to stay on a minimum of 6 months. And what that allows us to do is they're able to introduce kind of the new dentist, the new associate dentist, to 90% of the patients that are going to go through the clinic. Because again, for the hygiene side, you're normally going once, twice, 3, 4 times a year. So in a 6-month period, you're going to get most of your patients introduced to the new dentist. But it's funny, talking to the deal team, when they're having conversations about buying a dentist, a lot of times the dentist will say, look, I really want to retire. And then, you talk to them for a little bit and it's all of a sudden, no, I just want to slow down. I want to work 2-3 days a week. So I think a big part of what we do, we don't throw LOIs out to the wall and see what sticks. We really get to know, we have very specified targets. And when we really get to know those dentists, we really understand what they want to do. So we have some dentists want to stay on 6 months. They're out, they're really ready to retire. We have some that just want to take a step back, work 4 days a week, 3 days a week. And then we bring in an associate to kind of fill the gap there. But we see all different types, and we're really flexible in how we do our deal structures based on what that dentist wants. So it's very, dependent on the dentist. We see a lot of different types of deals that we're doing. And then a lot of times we have this earnout attached. We want to make sure that the dentist is maintaining that revenue of the clinic. And so we obviously attach an earnout to that. So yeah, I would say it really varies is kind of my answer to that. And, once you get to talk to the dentist, sometimes it changes from what they originally told you to what you guys end up working out.
It's really interesting that you mentioned that, because like a lot of my clients who have retired, a few of them will say, "Oh yeah, no, Eric, I'm not going to do anything. I just want to
Yeah.
sit on a beach and relax." And I talk to them 6 months later, and they're like, "Oh, I'm pulling my hair out. I'm so bored. I've got 3 new consulting gigs. I'm helping this company." Like they if they love what they do,
Yep.
and I think that being a dentist is probably one of the more intimate client-patient relationships
For
someone
sure.
or relationships someone can have with their customers. I think it would be hard for some of them who really do enjoy what they do to walk away completely. But I like that there's an element of progression that brings them some stake in the game, some
Yep.
reason to stick around, some reason to contribute. Um, so let's move into the next topic then, buying the clinics. What is it that you guys look for when you're looking at a clinic? What has to be true for it to get past the first hurdle?
Yeah, so and it's really evolved over time, right? So we're at this point now where we're buying larger clinics, whereas before, just starting out and kind of building out the platform, we didn't we knew what we wanted, but we definitely made some mistakes along the way of exactly what we wanted to buy. But right now, kind of our baseline of what we're looking for is $1 million in production. We're looking for 4 or more operatories or dental chairs, which is the kind of same thing there. A strong hygiene side, like that's really our bread and butter. That's where that recurring revenue comes from. That's where that recession resilience piece comes from. So we look for kind of 30 to 35% of the overall revenue of the clinic coming from hygiene. That's very important to us. Long-term leases, that's another one. We don't actually buy any of the real estate associated with the dental clinics. So we want these long-term leases in place. It's a headache to deal with landlords, obviously, as everyone who's listening to this podcast will be well aware. And we don't want to have that, right? We don't want to be negotiating all of these leases all the time. So we like to have those in place, kind of as we're purchasing these clinics. And for us, a key piece to what we're doing is buying in clusters, right? So we've got a cluster in Mississauga, a cluster in downtown Toronto. So good location for us. Like that is paramount, absolutely.
Interesting. So when these dentists are exiting, how do you structure the deals? Tell us when they fully exit, and when they decide to stick around, say they stick around for 5 or 10 years still, do they still have skin in the game, or do they just now contract essentially?
Yeah, so kind of like I said earlier, it really does depend on how long the dentist wants to stick around. So minimum for us is 6 months. That way we can introduce them, obviously, to all of the patients within the clinic. But we've had dentists that have said, "Look, I only want to stick around for 6 months, a year," and they're still with us 5, 6 years later. So it
Interesting.
really, yeah, right. It's like, and I think it's a testament to the team that we've built here, and kind of the model that we have, right? There's other private equity groups within this type of space, and there's certain horror stories that dentists will hear, about other private equity coming in. And I think once they realize that we're here to partner with the dentist and the dental clinic, they get very comfortable with it, and they really like the model, and then they kind of continue to grow with us. So we really do see all kinds, right? 6 months up to 5, 6, 7 years. And how it's structured is we're buying out 100% of the clinic, but we're keeping them on a revenue share agreement. And that keeps us aligned, with the dentist, with the investors, and everything, right? We don't there's no salary involved. It's the production that the dentist brings in. They get paid, approximately 45% of that production.
Interesting. Yeah, yeah. So obviously it really matters who you become partners with then. How do you assess whether a dentist owner is a good fit or not, or what would cause you to select out to say, okay, we're not interested in that because of certain attributes that may exist?
Yeah, we've been doing this for a while, and I think it's been a learning experience to kind of understand who you want to partner with. We spend a lot of time with the dentists ahead of actually signing anything, right? So you get a really good sense of the business that they built, the way that they treated their employees, etc. And I think really getting into kind of the relationship side of the business, you can understand pretty quickly whether someone is someone you want to work with or not. And I think having our full team, whether that's Dental Look head office, whether that's Abbas and Sean at the New Look head office, they're the ones that are actually speaking with these dentists, doing the on-site due diligence. And when they're doing that, you can very quickly understand whether this is someone that can fit into a team environment, whether this is someone that you'd want to work with personally. So I think it's become very much of a feel type thing for New Look, right? It's a lot less about numbers, a lot less about certain things like that, and it's a lot more about how do you interact with that person.
Yeah, it's interesting. Again, going back to our very beginning conversation about how people are often the biggest factor in what makes a investment good, whether it's their expertise, the culture in the organization. It's interesting to hear how you guys assess that. So now I want to move a little bit more into how you guys create value. You purchase, these practices. Once you buy it, where do you find the easiest initial few wins, in the first year to 2 years?
Yeah, there's a lot of areas that we actually do get some easy wins. So again, first piece really is the real estate being optimized? Like, is there room to add another operatory in there? Because each operatory accounts for approximately $350,000 in revenue. So if we have the ability to actually add one for minimal capex, and we can add 300 grand every single year to our revenue, then that's a very easy way to actually bolster the business. Another piece to that is schedule optimization. So we've always done schedule optimization. We've very recently done more of like a real-time data software analysis that we have at the head office level. So we can track, minute by minute what the scheduling looks like, what the billing looks like, etc. So that's a big piece of it, right? We want to make sure that as people are canceling, we're able to fill those appointments. We want to make sure that the hygienists are spending as much time in the chair as they can. We're seeing as many patients as we can. At the end of the day, it really is all about patient experience. And we want to make sure that people are having the best experience that they can while also optimizing, right? I don't think one has to come at the fault of the other, right? You can do both. I think another big piece I would say is optimizing hygiene, right? So for us, if maybe the hygiene isn't where we want it to be, that's a big focal point for us because again, that really helps create that recurring revenue, that recession resilience piece of the portfolio. What else would there be? I would say those are the big value adds, the easy things that we kind of look for right on the onset.
Yeah. Well, and to step from that into the next one, you guys talk about clusters.
Yep.
Tell us how that optimization comes into play and kind of your the long-term goal of what clustering is doing for the fund.
Yeah, no, that's a great question. So this has always been part of the thesis, and clustering really helps. One, we're getting bulk discounts, right? If you've got a group of clinics in a certain area or even a platform of clinics for us, you can get kind of those discounts on supplies, equipment, etc. So you can really bring down your expenses that way. But ultimately, the goal of clustering is, let's say you've got 5-6 clinics in a certain geographic area. Well, we focus heavily on the hygiene side, not necessarily on the actual, the dentistry work, the ortho or the endo, all that stuff, right? Or something that we currently are just starting to have in-house is kind of like your Invisalign. So we want to do those specialty treatments, but we don't want to employ, if we've got 35 clinics, we don't want to employ 35 specialists, right? That's far too expensive. So if you've got 5 or 6 clinics in a certain area, you can have a traveling specialist and, Monday you book one clinic kind of full on the specialty side. They travel there, do all of the work on the Monday. Tuesday, they're at the next clinic, Wednesday, the next clinic, et cetera, et cetera. So you can just fully load those days and have that specialist travel around within your cluster of clinics. And this is really only, you're only really able to do this if you have them in a certain, kind of close geographic region.
Interesting. Yeah. A follow-on question to that. So from an investor's perspective, how much of the value you're creating in these individuals as well as the fund as a whole that come from operational improvements like that, mm-hmm. or how much of it's going to come just from the pure multiple growth? Because there's a strength in consolidation, But I do know there's also things you can do, like you've talked about, to improve hygiene or to improve other revenue points. How do you balance that, and what do you kind of expect that to affect the investors' participation?
Yeah, so like on the operational kind of acquisition side, I would say that makes up between 60 to 70% of kind of what the investor would see there. 30% would come from our multiple expansion. So we rely, I would say, heavily on the operational efficiencies created, the acquisitions, increasing the number of operatories within a certain clinic. So things like that make up a bulk of kind of where the value is created. That being said, there's still a good portion, obviously, on the multiple expansion. Just to give you guys a bit of a sense, historically speaking, you've seen double-digit type exits in the healthcare space, dental included, and we're buying single practices at 5 to 7 times. So you can see the multiple expansion there.
Yeah, yeah. So I want to take a step back too, and kind of go to the more human side of it. A lot of people will say, business often will like just run over the human side of it. How do you make sure that the push for efficiency doesn't erode the patient experience, or the dentist's ability to practice the way they want, to be able to provide the level of service that that lets them enjoy their job?
Mm-hmm. Well, I think our whole model actually is kind of based on that. And I don't think one has to kind of take over the other. So for us, a lot of what we do, we take over the management of the clinic from day one. And this alleviates, call it 50% of the stress for the dentist from literally day one. And we see an increase of about 10% in revenue just in year one, because we've taken the management off of the dentist's shoulders. So I think a lot of what we do, Eric, is it's back office stuff, right? We're not impeding what anybody's doing. We're actually taking work off of the dentist so they can be more efficient and they can help their patients more and have actually a better patient experience. What we do actually allows for a better patient experience. It's not like one hinders the other effectively.
Yeah, it's rare that I hear dentist friends that I have complain about how hard it was being the dentist. It's always problems with the business supply, or our delivery didn't show up for whatever it is. So yeah, again, there's the factors that seem to cause the stress always seem to be business related. Definitely not. I didn't enjoy my patients today.
Exactly. And if again, our group, that's what we do. We come in. We've built a fully fledged head office team of 25, 30 people that take over that from day one, and now they no longer have to worry about that. It's not a burden for them. So yeah, I would say it completely frees them up to spend more time with the patients, be more involved, and really create a much better patient experience.
So on that note then, what's the hardest thing to do when you're integrating a new clinic in? What are your biggest challenges? What's the hardest part of that?
Yeah, so I'm not on this side, but kind of speaking with the deal team, they always say the introduction, like right at the day one, is kind of the hardest, right? It's you go in, you've obviously been having talks with the dentist, and now you speak to the full team and you say, look, this is kind of the direction we're moving here. Newlook is taking over kind of the management of the clinic, and it's very key that we have personnel there. So like Sean Abbas will be there, our Dental Look head office team will be there, and it's getting everybody comfortable with each other, right? Because again, we talk about, horror stories they've heard in the industry. Oh no, am I going to get fired? Am I not going to have a job come Monday? And we want to be there to assure them that, look, nothing is changing. Your day-to-day kind of stays the exact same. We are simply here, take a big burden off of your clinic team as a whole, frees you guys up to do the work that you love to do. And it's difficult because of the perception that they have of private equity. Obviously, a ton of people hear about it all over the place. So just getting them comfortable with our team, I think, is the hardest, but it's a very quick turnaround, and they very quickly realize, okay, this is a very positive for the clinic. So what we've learned from that actually is, don't close on a Thursday, Friday. Close the deal on a Monday or Tuesday, so you've got the full week, and the employees aren't stressing over the weekend, thinking they're not going to have a job on Monday. So we've learned kind of throughout the last, call it 8 years of the do's and the don'ts of the integration process.
Yeah, the definitely the thing that humans like least, I've discovered, is change. And then also change and not knowing what's coming next. So
Yeah.
I like that idea of the Monday, because it really does let them settle in with it. They get to know everyone faster. It's not a big, 2 or 3 days off now worrying about the worst case scenario.
Yeah.
So tell us a little bit more then about what Newlook brings to the table when a clinic comes in. What parts does Newlook take over? What parts don't they take over? Where do those efficiencies come in, and how does Newlook apply that to the fund level?
Yeah, so I mean, again, we've got our dentist, Dr. Sam, like the partner at Newlook. He runs kind of the operations side, the full head office there. And his experience has really helped kind of guide us and shape Newlook into what it is. But for us, we really take over all the small details, right? We've integrated a software platform where we can track every single dentist, every single clinic, all of the scheduling, the daily revenue. We're tracking all of these data points so we know where we need to make adjustments. We're kind of taking over certain accounting systems as well, right? We are taking over the procurement. So we're doing all the supplies, all the equipment, we're doing all that purchasing. Again, getting that bulk discount on that side. But we're really taking all the stuff that nobody wants to do is kind of what we're here to go do, right? We've built a head office team that's able to kind of take that workload on and let people do the job that they love to do. So it's all of those types of small tasks. A lot of it is also education, right? If you're just think about kind of in your own life, in your own job, right? If you're bogged down with very mundane tasks on a regular basis, there's no learning involved, right? You're kind of stuck. But we want to make sure that the hygienists are kind of up to date on education, right? If you've got 3 buckets of patients, like you've got your low risk, your medium risk, your high risk, well, we want to make sure that we're offering them the proper services. Whereas if you're just constantly worried about doing other things, whether that's, signing off on something or ordering, certain supplies, you're going to forget about certain, aspects of your actual job. Whereas we're freeing people up to be able to do that, which creates efficiency, which allows people to actually, use the education that they have to give the best possible patient experience and the best possible, information to these patients and what they absolutely need. So,
Yeah, no, that's interesting. So we're going to transition. This will be the last question I've got on the micro clinic level. At the platform level, how do you decide when to slow down acquisitions and focus on digestion, or to step on the gas and pick up more? Like where's capacity at? How comfortable are you guys with acquisition speed? And are there times where you have to just say, okay, yeah, we got enough right now. We got to get everything into the program. That scaling, or that speed at which you're able to bring things in and make them effective, that's really the question I've got.
Yeah, no, it's a great question. And I think for us, we always try and be 2 steps ahead. And by we, I mean kind of the management team, obviously. Like when they built Newlook, this was, they really thought about it. Like, to put it very loosely, they really thought about what they were doing here. And for us, in every sense, we're trying to be 2 steps ahead. So what I mean by that is when we started this, we knew that if we wanted to scale this, we wanted to get to 50, 75, 100 clinics, we would need a very large head office team to be able to sustain that. And if that's what we needed, and let's say we got a massive influx of capital and we could buy, 10, 15, 20, 25 clinics in any given year, well, we didn't want to be behind the 8 ball when that happened. So we built the head office team kind of ahead of schedule. So we have, short answer is, we can take on as many acquisitions as we need. Like, we have a head office team that is absolutely able to handle, 15, 20 acquisitions this year. So that's no problem. So we don't really, take our foot off the gas from an acquisition perspective, because years ago, we made sure to build the head office team to such a point where we could integrate as many clinics as we needed to in any given month, in any given year. So for us, we're always in acquisition mode. And that's really going to be apparent in 2026 and kind of going on here. We've obviously introduced our new equity offering in 2024. That took a bit of some time for us to integrate, and now the real focus is acquisitions. So for us, because of the head office team that we've built up over the last, call it 6-7 years, we are able to integrate as many clinics as we can effectively buy.
Interesting. Yeah. So I guess a follow-on question to that then, how quickly does it take you to deploy cash that comes in from investors, and what is the cash account usually sitting at, like from a overall fund percentage perspective? Because I know like excess of cash, not being able to deploy it or not deploying it soon enough can create a lot of cash drag, which can affect overall returns. What's Newlook's process look like in that regard?
Yeah, so I mean, we've got a very large pipeline of clinics at any given time. So it looks like between 15 to 20 million. If you're ever to kind of take a look at, the clinics that we're talking to. From a cash perspective, I would say we're typically 2 to 3% of the fund, maybe is what I would say. Turnaround's very quick, right? Like these, we can close a dental clinic, I would say within 2 to 3 months, 3 months to be conservative. So again, as quickly as we can raise the cash, we are able to effectively put that out the door, assuming again we're finding really good clinics, ones that we want to integrate into the platform. I've obviously talked about what we look for, and one of the key pieces of Newlook and why we've been so successful is we're very picky in what we buy, and we're not just going to buy something for the sake of taking cash and putting it out the door. We want to make sure that we are very selective in buying the absolute best to integrate into the platform.
Got it. Yeah. That's interesting. So I want to take a little bit more of a step back now and look at some of the macro forces that kind of play at the dental industry. Kind of touch back on the CDCP. What are the biggest factors that you guys are looking at that kind of tell a good story for the future of dental? What's happening in the next 5 to 10 years that'll make this roll up interesting to a prospective buyer?
I would say, the volatility that we're seeing in the markets, public equities being a prime example of that, just the recessionary pressures that we're kind of feeling, all of those recessionary macro forces that we're feeling. Healthcare and specifically dental, like I've said, is just such a recession resilient sector to be in. So we see this as being a massive tailwind for us. And this is really highlighted, one of the largest DSO in Canada formerly was public, and it recently was taken private. So this kind of shows you that, these other private equity groups, these larger asset managers are really trying to get into the healthcare space because they see what's coming. So we see this as a massive tailwind. Again, we're never excited about a recession. I don't know that anyone really is. But for us, we're not worried about it, right? There's a lot of sectors out there that are in those recessionary environments can get hit very hard. And dental seems to be one of those ones that is very, very resilient to it. So I think that's going to have a great effect for Newlook, all the funds and the businesses that we're buying here. So that's a great tailwind. If you're looking at from an inflation perspective, that was kind of one of the macro risks that somebody brought up the other day. And kind of the rebuttal to that is, well, the fee guide is set by the colleges across provinces within Canada. So let's say we have significant inflation, the fee guide actually increases at the same rate of inflation. So we don't really get hit by that, right? It's another kind of recession or inflationary resilient piece to that. So for us, we're not too worried about what's coming our way, but rather taking it as a tailwind versus a lot of the other sectors people can be investing in.
Well, actually, that brings up a good point too. You talk about recessions. Let's rewind to 2020, 2021 when COVID hit and the lockdowns happened. How did you guys respond to that? What did you see, and how did that affect your overall revenue or your outlook on how these dental practices performed through something like that?
Yeah, I think that's a great question. I categorize it slightly differently, obviously, than like your typical recession. It was more of like a black swan event. But in any case,
Yeah.
I think it's a great case study, Art, because nobody really knew what was happening, right? When it first happened, it was like, are we ever going to open? What's going to go? What's going to go on? So as you're well aware, dental clinics obviously had to close, but we had our full head office team. We prepped them and we said, look, at some point we're going to open. So let's be ready for like on day zero, when that happens, let's be ready to actually open up and have patients come through. So we made sure that we took all the precautionary steps. We had the proper PPE, etc. We had everything ready in place. So the minute that we were allowed to open, we opened our doors and patients came in. And what we kind of saw, which was very interesting, we opened up probably about a month and a half earlier than a lot of our other competitors. We're a very dynamic, kind of nimble head office team. Some of the larger groups obviously had a bit of a more difficult time opening up, as they have far more clinics than we do. So in that regard, we were able to open up faster, and we actually captured a bit of the market share, right? If you're a patient and your dental clinic closed, we open up faster. Well, if you need your teeth done, cleaned, looked at, restored, whatever it is, you're going to go to the one that's open. So for us, we actually were able to capture some of that market share. So black swan event, recessionary environment, we've done a really good job. We being obviously our operational team, I had nothing to do with it, so I can speak very highly about it. But yeah, they've just done a phenomenal job at the operational level.
Yeah, not bragging at all when it's the other department, eh?
Correct.
Yeah. So then, what about technology? How is technology affecting what you guys do? I imagine in the back office, it's easy to apply some of that technology, but what's really making the difference, and what technology in the dentist chair is coming along, or like when the dentist is actually practicing, are there any major changes that are either presenting challenges or are really giving you guys a leg up?
Yeah, I would say the absolute biggest piece of technology that's helped us is this new software that we've added to get the real-time data. This has been an absolute game changer for us. We have seen exactly where the revenue we're missing out on is, how we can capture that revenue, and this is day to day. This is not like the end of the quarter we get a report. This is minute by minute in the office. We can see live data from every single clinic. So I think this, and we have recently integrated, like I'm talking, the last 3 to 6 months we've integrated this. So, for investors who haven't invested in going forward, this is going to be a really great tool for our team to be able to utilize. As far as in the dental chair, I haven't really heard a whole lot about the technology on that side, or what can be integrated, but I can kind of touch base with Sean and see if there's any big technological changes on that side.
Interesting. Yeah. Well, with robotics and all kinds of the new AI stuff that's being put into the whole mix of everything, it's really interesting to see when and where it gets applied. So I was curious to know whether you guys had seen any of that start to hit the dental scene.
Yeah, not really. I haven't really seen a whole lot of that, come up in the clinics that we've acquired and we have at the platform. Not to say that we're not going to use it, but yeah. So we'll kind of take a look, I guess.
Interesting. Yeah, more curiosity than anything. So I want to talk more about the less glamorous side. What are some of the biggest risks that are presented in the fund? And what are the things that an investor really needs to understand before investing in it? And I'll start with one. Illiquidity is a big issue when it comes to private capital. A lot of people will look at this and say, "Oh, I want to invest in dental practices." Well, if they need their money next month, then it's not a good place. And so,
Right.
What are some of the biggest risks that you see that really should put the brakes on for some people?
Yeah, I think you kind of hit the nail on the head, right? It's liquidity is a big piece of that, and I think just understanding your financial situation is very, very important, right? So speaking to your advisor, to your dealing representative, people who have a holistic view of your financial status and kind of what's going on. I would say that's something that not a lot of people think of. People think that, you know, the private markets, it's this new shiny object. I'd love to be a part of it. But they're really not considering what these are real businesses at the end of the day, right? It's not a publicly traded security where there's a ton of market psychology. There's, you know, millions and millions of outstanding shares, etc. So I think that's a key piece, is just make sure that you're having those conversations with the professionals in your life, just to understand what's all involved.
And to kind of follow on with that, we want to make sure everyone who's listening understands that this is not financial advice. Financial advice is very individualized, and while some of these things work for a lot of people, the best way for you to know if it fits you is to have a conversation with an advisor who understands that. So I want to make sure that that's our caveat to the discussion today. What about risks like key person risk? How does that factor into it, both at the fund level and at the dentist level?
Yeah, so for us, that was obviously a big part of us structuring the fund. So we've got key man insurance on Dr. Sam. So that's one of the ways we've kind of minimized that risk. And another key part of that is building a full head office team around him. So we've got second and third line management that really integrate well with Dr. Sam, can kind of step in to those types of roles if need be. So I think that's been a key piece from a risk mitigating factor for us.
Yeah, interesting. So let's now move to the actual mechanics of the fund itself. I want to talk about return potential, investor perspective. Really, if I'm investing in this, what are some of the key things I need to know about the way it works, what to expect? What are investment minimums? What are the different classes? Because I do know you guys just introduced another class. And it was kind of funny because, like, at the very beginning when Newlook Dental started, my biggest complaint was, well, it's a debenture, it's a fixed return, and there's no potential for upside. There's got to be a lot of upside in this. And so that was my only annoyance with the initial offering. But you guys have now recently added the equity option, which allows us to take on more risk and potentially a better return. So explain the classes, how they work, and how they might apply to just an investor who's come along and trying to decide which of them they should be buying.
Yeah, so kind of the first piece to that, Eric, is when we started Newlook, we wanted it to be accessible to all Canadians, right? When you're investing typically in private equity or historically, you're looking at hundreds of thousands of dollars, maybe millions of dollars to actually, if you wanted to buy these businesses individually, it's going to be a very large check. Or, you know, getting into some of these larger private equity groups, there's significant minimums. So we kind of wanted to change things. We're distributing private equity, so we pay out distributions along the way. And our minimum check size is $10,000. So it's a lot more accessible to the average Canadian, and that's really how we wanted to have things structured. And as you said, we started out just doing a 9% debenture. Reason for that actually was having it structured as a debenture meant that the investors ranked above our management equity. So management put about $10 million of their own equity in. And since it was kind of a concentrated portfolio in Saskatchewan, we wanted to really de-risk this investment for the investors that we had. And by doing that, or how we did that, was offering this debenture. So again, if worst case were to happen, the fund were to blow up, they would get paid before our management team would get paid. So that's why originally we started with the 9%. And then, you know, we went to 3 provinces, call it 30 plus clinics, over 80,000 patients. And it became a much more diversified portfolio of dental clinics across Canada. That's when we said, look, a lot of the feedback, like yourself, came in that we want actually a piece of the upside, right? We want equity participation in this platform. We can see your ultimate exit, your goal, kind of down the line, and how you're going to get that multiple expansion, et cetera. We would love to participate in this. So we introduced still a distribution, so 6% as return of capital, but now you actually participate in the equity upside over the coming 5 years. So we're going to continue. We are going to show kind of the appreciation of the platform as we continue to acquire more clinics, add growth to the platform. But it anticipated we're right around that 15 to 20% IRR to the investor.
Yeah, that's good. The probably most of my clients, when the equity option came out, converted from the debenture to the equity. Not all of them, but yeah, it was a good opportunity, and I think that people really do come to these types of investments for the higher risk in hopes of earning an enhanced return, and
For sure.
and so I think that equity option was very much a no-brainer for at least most of the clients I've worked with. So you talked about your IRR, the two different classes. Explain how the drip works, and do you guys have a discount for the drip?
Yeah, so something we've always offered across both of our funds has been the dividend reinvestment plan. So again, if your investor doesn't necessarily need the cash flow on a quarterly basis, they're able to kind of compound those units. So for dental, it's a 5% drip discount. So what that means is when you're going to get your quarterly distribution, let's say the value of the units are $100, you would only pay $95 per unit. So you kind of get a little bit of an extra bonus there, and you're also compounding your units kind of throughout the life of the fund.
Yeah, I find, again, unless I have a client in retirement who wants the cash flow, the vast majority of my clients really put that drip to work. And I encourage them, if it suits them, because it really does enhance what you're doing when you're able to buy it at that discount. I think that makes a pretty big difference. So for the equity units, you talked about an IRR of 15 to 20%. What needs to go right for that to materialize?
Yeah, I think the big thing for us is continue to acquire. Right, I think we're absolutely on the right track from an operational perspective. Continue to do, what we do and buying the proper clinics, integrating them the way that we have been, but making sure that we're buying enough quality clinics throughout the year. Right, that's going to be a big piece of this. We're at 35 clinics now. We want to double the size of this platform. There's no question. So for us, it's continuing to find quality clinics, acquiring them, and really building out this portfolio.
It kind of take a step towards the public markets now. How does owning this compare to just owning a basket of public healthcare companies?
Yeah, I think it's the specialization, right? So, like, if you're looking at a basket of healthcare companies, you're probably across a whole bunch of different sectors. And for us, the value is really created within the specialization for us, right? We are very niche, we're very specific in what we do, and we're very good at creating immense value within these specializations. Another piece to that is anytime you're in the public markets, you're looking at volatility, you're looking at market psychology, whereas in the private markets, you just don't really have to deal with that. It's consistent level returns, again, and over the course of, call it 5, 6, 7 years, that's where a lot of that growth is going to be created, and even more value will be kind of given to the investors.
Yeah, that makes sense. The private markets really do present a different set of risks, and I think that's one of the reasons my clients like the or the private market, is that they do act differently. Even if you have the same thing, it's a level of diversity that you just can't get when the public market moves in a major way, like we saw in 2008 as a good example. It didn't matter where you were; everything moved in the same direction, and that potential of diversity, of stability that the private equity markets can bring, can be quite helpful in those scenarios.
Yeah.
So I think we're kind of getting close to wrapping up here. I don't know, Jim, Ryan, did you guys have questions that you wanted to ask? Anything that's accumulated in your minds that you want to get out?
Ron, you're echoing when you're. Give it a try.
Testing 1, 2. Can you hear me?
Yep, we got you.
So the only question I really had, and you kind of covered it, a lot of it, is if people are looking for something different than the usual mutual fund or investing in securities. I invested in this. I love the option. I went to my dentist and talked to him a lot about his margins and where his aches and pains were running the business. And Kyle, you covered pretty much everything that he said as a pain point for him. I felt this was also a bit for a lot of dentists out there to kind of, hey, if you're thinking about something and there's a couple other dentists in the area, maybe this is a good option too, to start winding your business down or make your business a lot more streamlined and allowing them to focus on the things that they need to focus. So That's really the only thing. Thank you very much.
Yeah, no, appreciate it.
I guess my question, Kyle, geographically, focusing on Canadian practices currently, is that correct?
Yeah, that's correct. We're only in Canada.
Only all provinces, territories, or is there certain regions you're not currently focused on?
Yeah, so right now we're focused on Alberta, Saskatchewan, and Ontario.
Okay.
Just by virtue of that's where some of the clusters, the good deals that we've seen have been. Current regional managers are in these areas. Not to say we wouldn't expand and go into different provinces, but this is currently where our clusters are.
Okay. And then would you say that you're setting up as a franchise model, or when you're purchasing a practice, are they under the same Dental Look branding, or do they kind of maintain their own individual branding?
Yeah, they maintain their own individual branding. I think that's important. We want to make sure
Yeah.
it maintains like the local culture that it's always had, the same kind of mom and pop shop feel.
Yeah.
We find that to be very important.
Yeah. And I'm going to repeat this because it's been said a few times, but I know when I have done some planning for some dentists, and their big issue has been running the business, right? Some of them want to kind of run away because they just don't want to deal with staffing and everything that, the accounting and all of that. But once they're given that opportunity to kind of offload that to someone else, they kind of get back to their first love again, which was actually to be a dentist and
Yeah.
and see the patients, and they're back into feeling the way they felt when they first started. And yeah, it's amazing just to see the improvements in their own practices. I've witnessed it myself as well as some of my clients. So it's wonderful. You know what, guys, we're past the 1 hour mark now, so I think we probably should shut it down. What I would suggest is if anyone's looking to find out more about the dental offering or some of the other offerings we're going to talk about later on, I encourage you to reach out directly to Eric. So Eric, how can people get a hold of you if they want to find out more?
Yeah, so the easiest is by email, eric@tvhgroup.ca, or you can phone me at 780-306-7359. And you can also follow us on Spotify, YouTube, TikTok, Instagram. But yeah, if you want to reach out directly, email and phone number is the best.
Yeah, they can also reach out to tvhfinancial.ca. There's a contact, and they can book some time with you through there as well. So yeah, I do encourage people. I've had a request if this is going to be offered as a recording. So this will go out YouTube. This will go out on all of our major podcast platforms. There will be a blog post as well, a newsletter. We're going to hit them all. And then they're going to hit all of our social media accounts, including TikTok, with Ryan doing a bit of a TikTok dentist dance of sorts, right? So
That's right.
Come up with a number there, Ryan.
Oh, okay. Well, I think if you're a 70s, 80s kid, you'll remember the brush your teeth round and round.
All righty. Well, on that note, I think, Kyle, thank you very much for joining us today and sharing the information and the opportunity on the dental fund. Eric did a great job as a host. I know there at first I was kind of like trying to be the passenger and then kind of went to the driver's seat, and I had to go back to the passenger side. So that was quite nice as well. So once again, everyone, thank you very much. And I think we're going to have another episode, I believe, in the next week or so. So stay tuned. We'll send out some more information on that one as well. All right. Thanks, guys. Take care.